In our summary, overall GDP has been growing at a slow rate. It's not significant enough to bring down the unemployment rate. Consumption has been up overall. Consumers are definitely more confident in spending. We also see that services are up. As far as investment, that has slowed down. Non-residential fixed investments have been stalling. However, residential construction, we've seen improvement there. As far as government spending, we've seen a lot of cuts, a lot of contraction there. There have been a lot of austerity measures, as well as them trying to maintain the balanced budget requirements. We've seen state and local spending contract, and then a lot of federal cutbacks. But net exports have been pretty moderate. There's not really any growth in the trade deficit. So unemployment is still pretty high at 7.9%. And while inflation is not a huge issue, we should still continue to watch that. And of course, I'm sure many of you have heard of the Fiscal Cliff that should be coming up in the end of the year. That will result in large increase in taxes, as well as a lot of spending cuts. This will bring the economy back into a recession and have a very devastating effect on real GDP. So as I just said, the fiscal cliff is the issue that the U.S. economy will be facing at the end of 2012. The Budget Control Act of 2011, all of the terms are scheduled to hit at the same time. So we'll see what happens there. So like I said, the Budget Control Act of 2011, among those laws, the end of last year's temporary payroll tax cuts, the tax breaks for businesses, that'll come to an end, shift in alternative tax, the end of Bush's tax cuts, and the beginning of President Obama's healthcare laws. And also the debt ceiling deal of 2011, that'll also go into effect. And over 1,000 of government programs are going to be scheduled to be cut. They're in line for deep cuts. So these are two scenarios. We're looking at the deficit. Right now, the yellow is if the fiscal cliff does happen and Congress does not intervene. So the deficit will go down sharply, and that will devastate GDP, send unemployment skyrocketing. The green is if Congress does intervene. That will bring the deficit down much slower and will have a less impactful effect on GDP. Now Carrie Ford.
My name is Carrie Baines. Recommendations for monetary policy and appropriate monetary policy actions. I don't know if any of you are up to date on economics or general news, but you may have heard about QE3 and its impact on the economy. QE3 stands for quantitative easing. This is the third round of easing that the Federal Reserve is about to embark upon. QE1 was done back in 2008, QE2 was done back in 2010, and QE3 just began in September 13th, 2012. What quantitative easing is, it's more or less the Federal Reserve going on the open market and trading for bonds. They're estimating that they'll be purchasing up to $40 billion worth of bonds, usually mortgage-backed securities per month. That's their anticipation for QE3. Their hope is that in the long run that they can lower unemployment and by making the long-term rates drop by purchasing more securities. The Federal Reserve has a dual mandate. Its main job is to foster price stability, stable prices, no high fluctuations in prices, and try to make unemployment as low as possible. Given these two, we believe that QE3 will work to bring about those two things. One, by lowering long-term interest rates, like interest rates that are attached to mortgages, car loans, and that sort of stuff. And doing that would stimulate borrowing. And hopefully, as companies start to invest and borrow more money, they'll hire more people. So it will try to alleviate the dual mandate. The arguments against QE3 are a few. First, primarily, well, rates are such a historically low level that it's been questioned whether or not QE3 would actually be effective. Maybe in the early 80s, home mortgage might have been 13, 14%. Now you can get a mortgage for, if your credit is relatively okay, for under double digits. So right now the rate varies, but it's under double digits. So the question is whether or not embarking on this new phase of QE3 will actually bring rates down any lower. The other issue is inflation. If you put too much money into the money supply, there's that possibility that it will overheat and that people will be having too many dollars flowing after too few products, and the price of those products will go up. So it will go against the dual mandate. So that's one of the issues that they have to look at. QE3 could increase asset prices, thereby triggering an asset bubble. Since they're targeting mortgage-backed securities, there's an issue with this. The unemployment rate, this shows an unemployment rate timeline versus from the financial crisis up until the present QE3. As you can see, back in late 2008, unemployment rate was around 6%. Now it is at around 7.9%. Top end for the unemployment rate was around 2010, when it was up to about 10%. This is when they embarked on this is when the first QE1 ended. This is a timeline from the crisis to the present day against inflation, and inflation being the rise in general prices. As you can see, it's a little above 1%, which is relatively good. We want inflation between 1 and 2%. You do want a certain level of growth within your economy. However, you don't want inflation skyrocketing to 6 and 7. So in terms of inflation, we're holding relatively well. The downside to that is that limits the amount of growth that the economy is seeing. This is a timeline against a 30-year mortgage rate. As you can see, beginning in 2009, in late 2008, early 2009, you're looking at about 6.5%. Like I said, way before that, you're looking at double digits. But this was the rate that roughly a 30-year mortgage would get you. Now we're looking at close to 3.5. So there's been a significant decrease in the 30-year mortgage rate. This is a timeline of new privately owned housing starts. This is a measure of how many new houses have been built. And you can see at the end of the crisis, it was a high of 840, and now we're back to pre-crisis levels. The market itself had bottomed out because of the bubble and the crash, but we can see a recovery. Part of our job in doing the FED challenge, we had to make recommendations for monetary policy actions coming in the future. And given the Federal Reserve's statutory mandate to foster maximum sustainable employment and price stability, we recommend maintaining the current target range of the federal funds rate at 0 to 0.25%, and maintaining the exceptionally low level of federal funds target rate through mid-2015. In addition, we recommended lowering long-term interest rates through QE3 by continuing to purchase additional agency mortgage-backed securities at a pace of $40 billion per month until the labor market improves substantially. Thank you.